Okay. Hello, investors. This is Don Vandenbord, portfolio manager with Revere Asset Management. And today I'm going to show 6 stocks that are examples of setups or successful execution of a system I've developed to ensure successful investing based on 13 rules that will reinforce it's not how much you make, it's how much you keep in the market. If you're familiar with our work at Revere, you're very well aware that we are proponents of active management and a system that will get you out of harm's way when the market turns dramatically south. I'm going to have plenty of examples over this. And one thing, we're not fear mongering. The market is in an uptrend right now, and we are participating fully in that uptrend. The important thing is that how much of that uptrend, how much of that money that you made during the uptrend are you going to be able to keep during the next downtrend? And I'm going to review 13 rules and build a foundation, show how you can build a foundation to successful investing to keep what you've made and participate in the upside. And then at the end, I will take questions and answers and do charts upon request. So let's go ahead and dive in and get started. First, I want to remind you our website, revereasset.com. Complete transparency. We do videos 5 nights a week under our daily market insight. We do podcasts on the weekend. And then, of course, if you want to subscribe to the webinars, anybody that's on already knows this. Anybody that may be watching this in the future and wants to get on the list, just click the webinars tab. We also archive these at our YouTube site. Just go to youtube.com and type in Revere Asset. You'll see a historical archive of everything that we've done, and this will be added to that later today. Want to remind you this is for educational purposes only. We're not suggesting that you buy or sell any stock or ETF, but what we're doing is presenting a solid approach to a common sense approach to the market. You know, when you think about it, there's no other aspect of your life where when things start turning south that you don't take action. For example, if it's raining outside, you're going to take an umbrella with you. If the temperature drops, you're going to take a jacket. If the service engine soon comes on your car, you're going to take it to get it looked at. But so many people have been trained by Wall Street to stay all in all the time and just hold on for dear life. And I'm going to show you that there's certain rules that you can follow to take advantage while the market is in an uptrend, but get out of the way when we can turn decisively lower. And this chart that I'm showing right here is a prime example of when you need to get out of the way. What we're looking at here from 2000 to 2002 is a 50% loss on the S&P 500 from the top to the bottom. In the middle of the chart, we've got a 57% loss. This was during the financial crisis from 2007 to 2009. And more recently, on the right side of the chart, a 20.2% drawdown in the fourth quarter of 2018. That's not all of the drawdowns that we've had over the last 50 years. Let me bring this chart in here. And I want to show, since 1970, look at the carnage that has at times hit your portfolio. 1970 down 37%, 1973 down 50%, 82 29%, 87 36%, a couple of 20% drops in 1990 and 98. Here's the 50 and 57% drops that I alluded to, 21.6% in 2011 and 20.2%, as I just mentioned, in the fourth quarter of 2018. You look at this chart, a lot of people look at this chart and they say, I see an uptrend where at all-time highs we recovered from everything. Sure we did, but what if you're approaching your retirement and you get hit with back-to-back bear markets like this? There's a concept called sequence of returns that's very important. You cannot afford, if you're approaching retirement, to take big hits like this going in. Nobody knows if a 20% drop is going to turn into a 30 or a 40% drop. A lot of people were telling you on TV to buy the entire way down during 2000 to 2002 and 2007 to 2009. But I'm going to explain a couple of rules and show you that there's an easier way to do it. We're all about empowering our investors and clients to do things on their own. But if you don't think you can do it on your own, we're here for you. We do manage money. We're a registered investment advisor, totally free of conflicts, completely transparent, and we'd certainly be happy to give you a free portfolio analysis. So let's take a look. Here are the 13 rules. I'm going to quickly go over them. And then I'm going to show how examples of how to implement this so that maybe your New Year's resolution can be to commit to never losing big, to holding on to your hard-earned gains. Life's dictated by decisions, and maybe going into 2020, you'll make the decision to commit to not losing money in the next bear market. The power of compounding when you preserve your capital and then the next uptrend starts will prove that you can make a lot more money this way than you can if you just hold on, not to mention the mental anguish that you go through. So we're going to start off with never lose big. What does never lose big mean? Well, quite simply, it means what it says. And why do you never want to lose big? Look how critical it is to cutting your losses early in any investment endeavor. If you get out on a 5% loss, the next investment, you only have to gain 5.26% to get back to even. If you lose 10%, you need an 11.11% gain to get even. If you hold on and you're down 25%, now you've got to make 1/3 on your next investment. If you get cut by half, like I just showed you with the market in 2 cases since 2000, you have to double in order to get back to even. And God forbid you hold on and you lose 75%. You need a 300% gain to get back on. To get back to even on that. And that's just brutal. And if you just commit to cutting your losses early, things are going to be a lot better. Second rule is follow the trend. Let me bring in a tool that I show in every one of my videos called the Growtection Gauge. Growtection is the trademark process that I follow managing growth accounts. And it means grow when you're participating in an uptrend and protect when the market is in downtrend. And right now we are in a full bullish mode. I use 3 time frames to track the health of the market. Short term uses a 21-day exponential moving average. That means you take the last 21 days of the major closes on the indexes and you divide by 21, and this is weighted heavily toward the more recent closes. So as long as the 5 indexes that I track in every video are above the 21-day exponential moving average, you're going to be at a +2. This means you want to participate in the growth. Intermediate term, we use the 50-day moving average. Same situation, you just add up the last 50 days, divide by 50, that gives you a number. If the current trend is above that number, you're in a healthy market, you're at a +2. Long-term, 200-day moving average, this is really the secret to never losing big. When the markets get below the 200-day moving average, this is time to really look out below, get out of the way, whatever cliche you want to throw at it. But right now, we're very healthy above the 200-day moving average. And it's also important to understand when the market is healthy, you want to take advantage when you're in an uptrend. This is the time to be buying breakouts, to be buying pullbacks to reasonable support on the charts. If the market's in a consolidation, buying something that breaks out to a high is a less than even proposition. But that's the time when you want to buy at support or start trimming some positions as they come into what's called resistance, which is a level on a chart that price has had a hard time getting above. And if you're in a downtrend, you absolutely, and by downtrend, you can classify this to any of the 3 time frames that I talked about, but this is the time to not be buying. You want to be selling either at resistance or something that's going down to newer lows. Let's go to the third rule right now. Diversify, but don't diversify. Now, what I mean by this is a lot of the pie chart money managers will tell you to just stay in there and think long term, just hang in there. But let me show you three examples. So let's start off with XLE. This is an energy ETF. Now, what I want you to focus on in these charts that I'm going to show you is this black line. This black line is the 200-day moving average that I mentioned before, and quite simply, it's just the last 200 closes in the energy sector plotted on a chart, and then where is price currently. At Revere, in our asset allocations, we've owned no energy while energy was in a downtrend here. But the trend may be getting ready to change right now. Look at the last two times we tried to get above, actually the last three times, energy stocks have tried to get above this 200-day moving average. Early 19, mid 19. Now we're trying it again in late 19. If we get back above it, this is a signal to start participating in the energy sector. But if you followed the trend, you stayed out of energy, no reason to be diversified into something that's going down. That's what I call diversification. Let me give you another example of it. We own gold right now. We've owned it since it got back above this black line, the 200-day moving average. But we didn't own it while gold was in a downtrend in this example right here from during 2018. There's no reason to be diversified into a downtrending asset class or a downtrending sector. Emerging markets, same situation. No reason to be in emerging markets in 2018 while it was trending below this black line. But we own them right now as we're above the 200-day moving average in our what we call our robotection portfolios, which are the newest craze in investing is these robo-advisors that stick you in asset classes and just tell you to think long term. Emerging markets is certainly one of those asset classes, but there's no reason to be in it when you're in a downtrend. If you're in an uptrend above the 200-day, that's the time to participate. Bonds, same thing. Take a look at BND. In a rising rate environment, bond ETFs are a losing proposition. All throughout late 2017 into late 2018, bonds were trending lower, interest rates were going higher. Now we get back above the 200-day moving average, and this is something we own in our robo portfolios, and also we own TLT. So there's a time to be diversified, but not diversified. That's an important concept to understand. So rule number 4, keep updated watch lists. This charting tool that I'm showing is called MarketSmith. It shows charts, and it's also an investing approach. We track the market, first of all. That's what the trend gauge shows, the major indexes, and those are the S&P 500, the NASDAQ 100, and what you're going to see is the black line here is let's bring up a daily chart here. The black line is the 200-day moving average. The red line is the 50-day moving average, so long term, intermediate term, and then green is the short term. And all of these major indexes are trending above it. That's why we're in a fully bullish position right now. So I showed the S&P 500, the NASDAQ 100. Here's the Dow Jones Industrial Average. Same situation, above 28,000, trending higher. The mid cap, not a lot of people talk about mid caps, but this is like the incubator for your next big growth stock leaders, trending nicely higher. And finally, small caps, which had lagged for an extensive period of time, but now have broken out of their range and are acting very well. So those are the 5 indexes. Out of those 5 indexes, they're broken down into 12 sectors and then 33 subsectors and 197 industry groups. And I'm not asking you to do all the work, but you do need some sort of updated watch list to keep track of what you're doing. And on video every week, I show my updated watch list. It's called the 21 over 21. And what it is 21 healthy stocks that are trending higher above the 21-day exponential moving average. This means across all time frames, short-term, intermediate term, and long-term. These are leading stocks that are trending higher. And honestly, that's the only watch list that you need. It's the watch list that I use to pull my investments in-house in the Grotection portfolio. And it certainly is a good way to keep track of what the leading stocks are in the market. Rule number five, use technicals and fundamentals. So this is an important concept. We're not just people that are watching charts. What we're doing is watching what the market's fundamentals are doing. And really what we're looking for is two things. One, strong sales and or earnings growth in a stock, and then a catalyst, something new, a new product, a new service, new management, new business conditions. And we use that as our first cut to create our universe of stocks. Then we're going to go to the charts. This is when the technicals take over. We want to identify low risk entry points to initiate a position. So as far as low risk entry points go, let's talk about the 6 examples that I talked about up front. The first one is going to be a stock that everybody loves, half people love and half people hate, and that's called Tesla. And it's near all-time highs right now. And something new, the N, happened with Tesla in their last earnings report. They were expected to lose money. They came out and made money. Now, I know there's a lot of people saying their accounting is fraud. There's a lot of people saying they're government subsidized. There's people saying all types of negative things about Tesla, predicting their failure. But all I'm focused on is the price right now. This was a big gap up, which tells us that Wall Street decided that they need to own this stock. Big gap up with big volume, and this pattern continues time after time after time. It's called a gap and go. It's a pattern that dictates long-term winners constantly, and this is the type of thing that we're looking for. Low risk entries. When a stock gaps up on massive volume, it should hold below the low of that gap day. And this is a perfect example of how it did it. And now if you didn't get it there, here's another low risk entry. This green line, the 21-day exponential moving average, look how it pulled back to the 21 and volume dried up. The 21-day is, we see it time after time, healthy stocks come there and they sit before they decide what the next move is that they're going to make. If it would have broken down here, I would have gotten out of Tesla, but it didn't. It held for a week and a half and created a nice low risk entry, a nice springboard for this big run that it's been on for the last 2 weeks. Let's show another example of low risk entry points. AMD. Semiconductors have been a leading sector during this most recent bull run. Here was earnings for AMD. It gapped up mildly, pulled back, and then it finally broke out of the base. I took an entry point here, very low risk, and rode it up, sold some here near the top. It pulled back, but what did it do? Again, it held the 21-day exponential moving average. Another low risk entry, added another half back, went sideways for a little while, and then took off over the last week. AMD, another great example of a low risk entry that's paid off. Third example, Vertex. This is another stock that's owned in the Grotection portfolio, and it's another example of a gap up on news. They got approval to expand their cystic fibrosis drug. Big gap up, goes sideways for a couple of days, breaks out. Low risk entry, and look how it's riding higher. Now it just pulled back into the 21-day exponential moving average and is holding it. This is what strong stocks do in strong markets. They go up, they consolidate for a little while, and then they take off again. Another example of nice gains in Vertex. And another fourth stock, Lulu. Here is a stock that broke out, pulled back, broke the 21-day exponential moving average, but held the 50-day moving average here. And this gives you another example of a low risk buy, either the 21 or the 50. In this case, it was the 50, jumped up, had a nice about 14% run, pulled back on its last earnings report, but didn't break below the low of the gap down day, which coincides with the 21-day exponential moving average that it's holding. And 2 videos ago, 2 lunch and learns ago, I did an entire class on handling gaps. If you want to check that out, it's out on our YouTube channel. and all I'm doing is following the rules that I set forth. So let's look at two stocks that are setting up right now for low risk entries. Shopify forming this very nice cup base coming up to this 400 level relative strength line. This is what tracks any investment versus the S&P 500 and the other investments in the market. So when you see the line heading higher like this, it means it's outperforming the S&P 500, and this 98 relative strength means over the past year, Shopify has outperformed 98% of all other stocks in the market. So what we're looking for right now is a little sideways action or a strong break above the top of this level. Shopify, and you can see they're in 2020, they're slated to grow their earnings 384%. Sales growth in the most recent quarter, 45%. And another one that's setting up very nicely, Splunk, SPLK. You can see this had the gap up, so this would have been one time to buy it. If you didn't get it then, what's it doing now? Pulling back on volume, on lower volume during the pullback, and then some volume came in as it bounced right off the 21-day exponential moving average. This is a perfect low risk entry, and you can use this 140 area as a stop out if you would decide to get into it. So two setups, four stocks that we looked at that are examples of implementing the rules. And again, this is just part of the system and implementing the system that we do here at Revere. Rule 6, and this is the most important rule that I'm going to go through. Always, always, always have a sell strategy. If you ask the typical financial advisor what their sell strategy is, they're going to look at you like a deer in the headlights because, frankly, they don't have one. And the golden rule to stay out of trouble, never hold any investment that's trending underneath its 200-day moving average. Now take a look at these stats for how important this is. Now since 1960, 22 of the worst 25 days and 83 of 100 in the S&P 500 occurred when we're under the 200-day moving average. The overall monthly return of the S&P 500 averages about 0.88%. But a monthly return when you're under the 200-day moving average is negative 2.6%. So as I say here, the only time it's not okay to have a sell strategy is never. And keep in mind, leading stocks, when they top before their fundamentals deteriorate, they fall an average of 72% from their peak. Don't get caught holding one of these when they break down. That means you need 257% just to get back to even. Next rule, rule 8, stay out of the dumpster. Well, next is rule 7, low risk entry points. So let's talk about that. I did mention the 4 examples here. Really, the 2 examples of low risk entry is the high volume breakout and the low volume pullback. Both examples I showed when we were talking about low risk entry points. So here's rule 8, stay out of the dumpster. Just don't buy stocks that you think can't go any lower. Time after time, studies show that momentum and growth stocks that are breaking out and have set up from good patterns and are fundamentally sound, those are the ones that are going to lead the market. So avoid stocks that are technically broken but are supposedly great values. You really don't know how low a stock can go. Rule 9, relative strength. I showed some examples of that when I pointed to a couple of the charts in there. The relative strength line is something that I'm always keeping an eye on because this identifies what the leading stocks are going to be at any point in time. When the market is correcting, something where the relative strength line is holding up or going lower, that can point you to the next leaders in the market. For example, back here, let's go back in time here to April of 2019. While the market was correcting in November, December of last year, these software stocks were correcting too. But starting in mid-November, and I talked about this in our videos, you can go back and check, the relative strength line on software stocks starting edging higher. This means while they were going down, they weren't going down as strongly as the market results were. And when the market finally finished its correction and came out of the correction in early January, we hopped on a bunch of software stocks and rode them to very nice gains. The relative strength line, can't stress its importance. It's one of that and the N, identifying something new that has relative strength. Those are the two most important characteristics for a stock that I'm always looking for. So understanding the math, number 10. What do I mean about understanding the math? Well, first of all, anytime you buy an investment, there's 5 different outcomes that can happen. You can have a big gain, a small gain. You can just about break even on it. You can have a small loss, or it can result in a big loss. If you just eliminate big losses, now I go back to the very first rule that I showed, never lose big. If you can eliminate big losses from the 5 outcomes of anything that you buy, this is, and use the 200-day moving average for this, it can very often be the way to find this. But tracking your gains and your losses and eliminating big losses is so important. I can't stress enough. If you can just have one of the top 4 outcomes anytime you buy something, your investment performance will improve substantially. Another thing to understanding the math is understanding how much risk the market is presenting at any particular time. And this is a chart that I like to use depending on what's going on with the market conditions, how much I want to be exposed. If we are where we are right now, where the market is above the 21-day exponential moving average and the 50 and the 100, I want the beta, or the exposure of my portfolio to the market, to be a minimum of 1, and it may approach as high as 1.5. Now, what does this mean? Beta is how an investment performs relative to the S&P 500. The S&P 500 is assigned a beta of 1.0. If you want to get market returns, you will have a portfolio whose beta is 1.0. But when all the odds are in your favor and you're trending higher above the 3 key moving averages, raise your beta. That's the time when the market's in your favor. That's the time to put the pedal down and really take advantage of strong growth stocks in leading sectors. If you break the 21 and you get back, but you're still above the 50-day moving average, maybe cut back a little bit, adjust the beta to 0.75 to 1. If you break below the 100-day moving average, what you're going to start seeing is leading stocks correcting also. And I find an appropriate beta is a half to 0.75. If we break all those, but we're still down above the 200-day moving average, maybe a quarter to a half of the market's risk is appropriate. And if you break the 200-day moving average, this is when risk picks up exponentially in the market. All of those big 10 examples of sell-offs that I showed since 1970, the heart of them happens after you break the 200-day moving average. And you may still be holding a couple of sectors or stocks that are acting well, so your beta may be positive. But if you're in a strong downtrend, you actually can take advantage of the market going lower by using inverse ETFs that go higher as the market goes lower. So a negative beta will allow you to actually take advantage of the market going lower. And now similar to what we found when we were below the 200-day moving average, but in January, we got something called a follow-through day. And this is a signal that we use to get our exposure in the market back up. And this is the time to get back in. You can still be deep below the 200-day, but it's a signal that the market may have bottomed. You've got a good stop out point because it shouldn't go below that recent low. And it's the time to start getting your exposure back into the market. And then as you climb back higher above these moving averages, you adjust your beta accordingly so that you're invested when the market is most healthy and you're least invested when the market is showing lack of health or the most risk. Another example of, let's go on to the next chart, and this is portfolio and risk management. When I'm evaluating an investment, I want to know how risky it is, and I'm going to control my position size depending on how risky or how volatile that is. Every stock that I look at has something called an average true range, or an ATR. And what this is the percentage that that stock moves on a daily basis relative to the price of the stock. So for example, the two most risky stocks that I own right now are Peloton and Luckin Coffee, PTON and LK. They have an ATR of 247 and 213 respectively. So I'm going to divide these by the stock price, and this tells me that their average true range is 7.6 and 7.5% respectively. These are very volatile stocks, and when I do my calculation of how much I want to own, I never want to lose more than a third of the overall portfolio when I take any entry. So this tells me that I want to limit my position size to, in this case, 3.9 and 4.5%. Now, if you look at something that moves a lot slower, for example, Vertex, bought it when it was $189. The average true range on Vertex was $4. That means that on average each day, this only moves 2.12%. So when I did my calculation, this allows me to take a bigger position size. In this case, it came out with 8.5%. So understanding how volatile your stocks are, you cannot have a portfolio full of stocks that are going to move an average of 7% in a day. You'll just get stopped out and you'll end up losing money. So this is an example of the math. And another example of math that I use for portfolio management is, I mentioned beta before. This is the current beta of the growth portfolio. This is what we own. This is the beta of each position, and this is the position size that we have. So as I mentioned before, a beta of between 1 and 1.5 I feel is appropriate for a fully bullish market. Right now the beta is at 1.39%, 9% cash. I always like to leave some cash available in case I need to buy something, or in case a hedging opportunity comes up. So this is, again, an example of tracking your portfolio, knowing how volatile each investment is, and position sizing accordingly. So that handles math and portfolio management. And finally, let's get to, well, not finally, but let's get to rule number 12 here. It's so important. Mr. No Opinion. He looks a lot like Dragnet Sergeant Joe Friday. Joe Friday, if you listen to all of the videos that I do, I end them with just the facts or telling it like it is. Maintaining a just the facts posture toward the market is so important. If you are following people on Twitter, or you're seeing on CNBC, or you're reading in the newspaper, there are people that are out there that are always trying to sell fear, or conversely, they're always trying to sell a bullish posture on a particular stock or an investment. Stay away from anybody that is a perma whatever. There are a lot of gold bugs out there that are permanently bullish on gold. There's times to own gold. We own it right now. But as I showed before, there's no reason to own it when it's in a downtrend. Keep your mind wide open, maintain flexibility. Opinions mean nothing. And as I'm always fond of saying, one more time, it's okay to be wrong. It's not okay to stay wrong. Check your ego and pay attention to what is actually going on, not what you think is going on. And then the final rule, Rule 13, it's about making a commitment to rules 1 through 12. You can have a list of things that you want to do, but you've got to absolutely commit to doing them. As Tony Robbins says, the path to success is to take massive determined action. If you're having problems with your returns, talk to us. Apply these rules. They're not an a la carte menu either. You don't just pick and choose what you want, but this gives you an approach to avoiding the mindless buy and hope, hang in there, ride it out, stay the course. Ultimately, the decision is up to you. You either choose the pain of discipline or the pain of regret. And we hear all the time from our clients about how soundly they can sleep at night knowing that we've got the Grotection approach applied to their portfolios. And that just simply means during uptrends, we're going to participate to grow capital, and during downtrends, we're going to sell to protect that hard-earned capital. So that's a commitment. that's what the time to take this. The time to do this is not when your portfolio is down 20%. The time to do it is now, when your portfolios should be near all-time highs. Having a plan to stay out of that next severe downtrend. Take 2020, make that your New Year's resolution. We're here to guide you. Watch our videos, listen to our podcasts, check out the 21 over 21 list, and follow the trend gauge. I present it every day that I do a video, and it's a very simple color-coded way of telling you what's going on in the market. And here it is right now. We're in a fully bullish, participating in the uptrend. We were fully bearish during December of 2018. It's all documented out there in our videos, and that's going to wrap this presentation. Now, I'd be glad to take any questions or take a look at the charts of any stocks that are out there that you want to take me a look at. And let's see what we have. Diane is commenting, EPS is going down. You are not scared on CHOP. Diane, I'm scared of everything. That's why I have a stop. The only good stocks are stocks that are going up. All we can do is attempt to put the odds in our favor. EPS is going down. It's not going down. It went down in 2019 because of some investments that they made in infrastructure, but it's stated to go back up in 2020, 384%. So this is a very nice cup and handle, but if I buy it, or if you buy it, or if anybody buys it, have a stop in place, know where you're getting out, and position accordingly. Next question, is buying a leveraged ETF the way you use beta in some of your portfolios? Yes, it is. Currently, we own SSO, which is 2 times the ETF, but again, you want to size it accordingly depending on what's going on with the market. So right now we're in a fully bullish posture. So I own SSO, which is 2 times the S&P, and also own TNA, which is 3 times the small caps. We've also owned recently QLD, got a little bit extended, and we also own UWM. It depends on the portfolio and the risk profile of the portfolio, but we absolutely do that. And then another way is by taking high beta stocks. That gets your beta higher, but again, you've got to position size them accordingly. What moving averages do I use for weekly charts? The 10-week, 20-week, 30-week, and 40-week. The 10-week is equivalent to the 50-day moving average. That's the red line. The black line is the 40-week. That's the equivalent of the 200-day moving average. Let's see, what other questions? Can you look at Amazon? Sure, I'd be glad to. Amazon has been a laggard for a while, but it's really starting to look pretty good. Let's break this down on a 60-minute chart. First of all, here on the daily chart, you can see it's still trending below the 200-day moving average, but it now has gotten back above. Let's go to the daily chart. You can see it more clearly. It's now gotten back above the 8-day, the 21-day, and the 50-day moving average. The rubber will meet the road when it comes to this 1800 area and the 200-day moving average around 1825. You can see the last 3 times it tried to get back above the 200-day moving average. It failed. That coincided with declining relative strength in the stock, but notice relative strength has ticked up this week. It had a little bit of a gap up yesterday off of this. Let's take a look on a 60-minute chart at it. If you really want to look at this from a short-term perspective, you can see I've got an alert set here right above 1720. This was the last low that it formed. Last pullback made a higher low in the high 1730s versus this 1720. Now you see the gap up here, and I've got another alert set at 1820 here, which was the recent high, and also corresponds with the 200-day moving average. So Amazon is definitely starting to look better. Can you take another look at Tesla? Sure. Tesla, again, here's an example of a gap up. Gap up, if it would have failed that first day, your failure point is the low of that gap up day for Tesla. Very low risk entry. But as you can see, it's also a highly shorted stock. So what happened is that people are, you got to cover your shorts. So that's initial knee-jerk reaction is if you're underwater in a stock, you got to get out. So sometimes in the first day or two, that's going to pop the stock back up, and that's probably what you saw the first 3 days. Then you want to see how it acts when it starts to pull back, and this was a perfect. I love to see it when it comes back and bounces off the 8-day exponential moving average. It did that twice, did it 3 times. This day here, this gap down was when they introduced that the truck. Very often, that's a sell the news situation, and that's what happened. People saying the truck is ugly, but then Tesla announced, "Hey, we just got 200,000 people that put down a deposit on this truck." That's a lot of money in their books all of a sudden. And while it digested that news, it never significantly closed below the 21-day exponential moving average, and then off to the races over the last couple of weeks. I've got an alert set up here at 289 and change. That's the all-time high. If you want to see shorts panic, be in something that passes 389.61, which makes the stock at an all-time high. That means if it gets above there, anybody that has ever bought the stock is profitable in it, except for the people that are short. So would have been nice if we'd have gotten this alert while we're doing this this webinar, but it just may not happen right now, but it may happen before the day is over. Or frankly, it may never happen. It might hit there, a bunch of people might take profits, it might roll over. I've got a plan in place regardless of what happens with Tesla. I will either lock in the gains that we've made or possibly add to it if it pulls back in a constructive manner to the 21-day exponential moving average. I've got about 3 minutes left. Any other questions? Now's the time to ask them. Can you take a look at Apple? Yeah, Apple is, strongest stock in the market. It fits the criteria of trending above all 3 of the major moving averages. It's near all-time highs, leading stock, huge weighting. Apple looks great. What is your stop on shop if I would buy it today? My stop would be the 21-day moving average. So right now, Shopify is 11.3% above the 21-day moving average. That would tell me right away that I'm going to have to size it down because of a stop that's wide. But you'll see the 21 is just coming up to this recent low. Let's take a look at a 60-minute chart. There's the big move. Here, every time it tested it, it didn't get below 359.92. The 21-day average is right around there. It's at 360.63. So my stop would actually below that 359.92. So really, I'm not going to buy this here. I think it's a little bit too extended. This would have been a more proper time to buy it. But if you're buying, your position size has to be small because it is 12% below a reasonable stop being the most recent lows of this consolidation. And it looks like that's about all the questions. So we're going to go ahead and wrap things up. I really enjoyed doing this webinar today. It's an A to Z look at the 13 rules that I've put together and how to take those rules and to build a solid investing foundation. And if you make any New Year's resolutions, make the New Year's resolution to be never lose big in the market, and don't give back the gains that you've made during this bull market. Every tick we go higher is one day closer to the next harsh correction. We're not predicting when that is. We have no idea when that's going to be. We're going to ride the trend as long as it goes higher. But when the trend bends at the end, we've got a plan in place to get out of the way. So that's going to wrap it. Thank you all very much. Merry Christmas to everybody. I'll be taking a break on these due to the holidays. The next Lunch and Learn will be in January. It'll be on a Wednesday, as always, at noon. And thank you all very much for joining. Take care.